Yeah, thanks, Tim, and thanks everybody for joining us today. And I appreciate the opportunity to be back on Hidden Gems. I'll start today by giving you a little bit of background for those of you that don't know the company, and then the real focus today, Tim, if we hop through to the first slide past the disclaimers, please. The real focus today is to take you through our half-year results for the half year to the 31 December. So an important thing that we did during the period was the acquisition of our industry peer Sentry Group, and so I'll talk a little on that as well. But as to history, so WTL was founded in 2010 under the name of Spring Financial Group, and initially our complete focus was on building a diversified offering direct to consumers using all salaried advisors. And we enjoyed great success and we were profitable from our first year. And really our success was based on a great range of assets and intellectual property that we built around advisor education and training, consumer education, and taking a really process-driven approach to the creation of advice and to risk management, and also to client recruitment and digital marketing. We listed on the ASX back in 2015 under the profits test, and our original code was SFL. We had a very strong dividend history in our first few years, paying out around $7 million in dividends. Then sort of fast forward to 2017, and we saw significant legislative and regulatory changes in the industry, changes to education standards, the Royal Commission. A bunch of these things really impacted not just on the industry, but considerably on the company itself. And it forced us into having a rethink of the best way that we could unlock shareholder value from the assets that we'd built. And we made a determination to exit out of a lot of the B2C operations that we had and turn our focus into the B2B market. And by the B2B market, I mean this is we started with the acquisition of a dealer group, what's known as a dealer group called Wealth Today. And what a dealer group does is it offers all of the licensing, infrastructure, business support, marketing support, and compliance regime, approved product lists, and the relationship with the with product providers like insurers and the superannuation companies and investment and asset managers. And it offers all of those services out to individual corporations, small operations, generally of sort of 1 to 3 up to 10 or 12 financial advisors and their support staff through what's called corporate authorised representative or authorised representative arrangements. And so when we acquired Wealth Today, it had some 42 advisors. We've leveraged all those assets that we've got, now expertise, to grow that network up to around a few more than 100. And then we acquired our industry peer Sentry Group in the middle of last year. It was a bit of a rough ride for shareholders across those few years as we made that transition. We wrote down a lot of goodwill, disposed of assets, and really took some time to exit out of a lot of fixed cost arrangements we had around accommodation and so on. So it was a rocky road for a couple of financial years there. We're lucky to have very supportive shareholders in the base that went on supporting the business and then stumped up again to support the acquisition of Sentry last year. And it's really enabled us to see some significant increases and a return to strong profitability. So if you just flick to the next slide for me, having a look at the half year, this is really, the half year's been the first reporting period since what I would call the conclusion of the first stage of our real transition to a predominantly B2B focused business. Revenue was up significantly to just short of 35 million. Consolidated EBITDA was just over nearly 1.7 million. Consolidated net profit after tax of 1.12 million. Cost of goods sold, you'll see, is rather high in our business, and that's because the relationships that we have with our corporate authorised reps is the revenue that we bring into the business through insurance and advisor service fees and so on. There's a large share of that goes out to that advisor base because they're not salaried, they're running their own businesses, and so they get a considerable share. Most significantly, I think, was the containment of our operating expenses. So OPEX was up just 16% on all of those other terrific increases. So the next slide for me, please, Tim. We're on track for our guidance for the full year. Is when we made the acquisition of Sentry, our guidance to the market was that this financial year was really focusing on merging the two operations together, making sure we got the cost synergies there and contained our costs. And so our guidance for the full year was circa $70 million revenue. So we're sort of bang on half of that for the half year. We're still seeing good growth in the year. Our EBITDA guidance was for 3.3 million. So we're right there or thereabouts as well. And we gave guidance of a net profit after tax of $2 million or greater. So we're really pleased with where we're sitting at from a run rate perspective for the year. And we expect to be able to really bring it home in the second part of the year and meet or exceed what our guidance is in the marketplace. Depreciation and Advertisation. We did a lot of balance sheet restructuring at the end of the last financial year. And so we've been able to contain our depreciation and amortization. In fact, it was down 33% on the prior corresponding period to just 250,000. Finance costs were down also to 189,000. I'll just talk a little bit on the tax. We've seen a statutory tax expense of a bit over 100,000 for the half year. The company's in a rather unique position of having significant carried forward tax losses that will enjoy the benefit of, but at the same time, as we're sitting on a franking credit balance of around about $1.5 million, $1.6 million or thereabouts. So we'll be in that unique position. We're targeting a return to dividends as and when the profitability provides for that, and we're certainly on good track for that. With the board and key executives in the business owning about 30% of the business, is everybody's sort of motivated and aligned with shareholders from a dividend perspective. So we're in that unique position of being able to look to, when we do return to dividends, pay out fully franked dividends without the burden of having to make cash tax payments. So next slide, Tim. I think the key thing for our industry is that it's been a bit of a roller coaster for us in the wake of the Royal Commission. A lot of the banks and others have exited out of the space, but we're very bullish about the space. Demand for advice continues to grow. We've got some $3.5 trillion about to pass from one generation to the next over the next decade or two. And this means that there's strong demand for estate and legacy planning, for retirement income advice, for aged care advice, and of course for strategic investment advice for the recipients of that transference of wealth. And what this means is that people need financial advisors. They need financial planners, investment managers and strategists in their life. And so we certainly don't see the demand going. We think the industry's got a very healthy future. These increased demands and the complexity of advice, however, really mean that advisors need to look to a dealer group with the sort of scale and structure that we've got to be able to offer them the right supports. And this also sort of marginalises some of the smaller players in the space. Next slide, Tim. I think we've got a couple of slides in this deck. Again, I won't get bogged down on the board, but we've got a great range of experience and talent, not just on the board. Myself and Guy Headley, Michael Harrison, Chris Colesis, Rob Jones heads our advisory committee, all really experienced in the financial services space, and also a lot of corporate M&A experience and equity capital markets experience in the team as well. The next slide, please, Tim. And I'll wrap it up with a slide there on great range of operators in our business. Our two joint chief operating officers, David Newman and Frank Paul, Jack Standing, Rick Jones, Rickton Jones, our head of advice, and also Danny Marr, who's our regional head for the East Coast, all very experienced in financial services. A great team of people sort of backing the company and backing the advisors in the group. So really pleased with the results for the half year. We expect continued improvement and to be able to more than deliver on what our guidance is for the full year. So thanks, Tim. If there's any questions, more than happy to answer them.
Yeah, thanks, Keith. Quite a few questions. Now, we have seen lots of consolidation, and obviously the big boys have kind of moved away from financial advice to a certain extent. Does increased scale give WTL the opportunity to increase advice margins? We see that, the advice revenue relative to costs. How does scale reduce those costs?
Yeah, look, Tim, I think in any professional services business, obviously that your personnel costs are your highest costs. And if you want to support a dealer group on any form of scale where advisors have got real demands for support of that intellectual property they need, experience in dealing with clients with different circumstances, with different types of investment markets and risk markets and so on, you need to have a certain level of intellectual property in your personnel, and that can be expensive. So, but you don't, as the advice network grows, as long as you've got the IP in there, you can really leverage that across lots of advisors. And that's the importance of scale. We've got a really strong management team with incredible intellectual property that's very used to dealing with clients one-on-one and dealing in those B2C markets to support their advisors. And so that's one of the key areas where the margins can grow.
And do you see WT Financial Group playing a more active role in consolidation? And will your growth come from further acquisitions rather than organic growth?
Yeah, look, there's three ways for us to continue to grow our revenue and our profits. And the first is by adding advisors organically. And advisors are on the move. They're still looking to exit some of these institutions that are floating around. A lot of them are sick of working within a dealer group where, that what they tell me is that the management in the group has either forgotten what it's like to sit in front of clients or they've never known it. And certainly when they come to our group, they've got support from people that know exactly what it's like sitting in front of clients. So the organic growth through adding advisors, and then there's improving and broadening the services we offer to advisors as well, is another way to sort of grow the margins and grow the profitability of the group. And of course, lastly, the transactional opportunities, and there's plenty of them in the market. There's a number of smaller players. There's also a number of large privately owned businesses out there where the principals are sort of getting towards wanting to transition to retirement themselves. So there's a number of players out there with 100, 150, 200 advisors that are privately held still, where their principals have never had a capital event. And then, of course, there's merger and acquisition opportunity amongst the listed peers.
And just on those listed peers, can you talk us through how you're kind of similar and how you're unique compared to those competitors?
Sure. I mean, I think really we're what I would call a pure play into the dealer group market, into supporting independent financial advisors. A lot of the others, like Sequoia, for example, or Climb Asset Management, or Eastern, now called Diverger, they have sort of a whole bunch of bits and pieces to their business. They're doing certain things with accountants. Sequoia is a great business from a share market performance perspective, but how it differs from ours is that they're producing some product, they're doing a little bit of this, a little bit of that. We're really staying focused on being the pure play and being the dealer group of choice for advisors. Probably the closest listed peer to us, I'd say, would be Centrepoint Alliance. They're very much that sort of pure play in the dealer group space as well.
And how are they priced, like relative to PEs and things like that?
Well, look, if I look at what the PE ratios that some of our peers are running on, I'm typically seeing 16 or 18 times. And that indicates to me that I think, we're trading at about 8 cents at the moment, based on an annualization of our half year results. As if you applied that 16 to 18 multiple to us, as you should land at a market cap of 35 to 40 million, which puts us in that sort of 12 to 15 cent range. So, I'd suggest, and I think I was looking at some Morningstar sort of automated research the other day saying fair value for our stocks about 14 cents. And I think I'd have to agree with them if you line it up against industry peers. And that's without considering what our growth opportunities are.
And Keith, as a pure play, in your words, what's the sort of target numbers you'd like to get to in terms of number of advisors? And how do you balance out that ability to service an increasing consumer base that's looking for financial advice?
Yeah, look, one thing that our team's been really good at, Tim, has been developing processes inside the business that are really scalable. And we do this through, very careful outsourcing of certain components of the business that mean we're not increasing our fixed costs and that we've got variable costs associated there. And we've always been very process driven. It was where our success came in the early days in the B2C market, was being very process driven in the business. A lot of dealer groups have suffered from this problem of, as they've got bigger, they just keep throwing more and more people at it. And they think that the way they solve any problem in growing their business is to throw people at it. It's not necessarily people, it's generally, processes and technology. And so look, where's our ideal number? I don't have an ideal number in mind. If I look at our larger peers in the market, is you've got AMP and IOOF with sort of 12 and 1,500 advisors. There's certainly the opportunity for one or more of us in what I would call the independent space, the non-institutionalized space, to start to rival those numbers over the next 3 to 5 years. But certainly we've got great capacity in our management team to grow significantly from here, and still be able to provide the right proposition for advisors.
Great, Keith. That's all we have time for. We'll finish there. Have a good weekend, and we'll get you back on in a couple of months' time and follow your progress.
Thanks so much indeed, Tim, and thanks everybody for joining us.